to 138% today. This is not just growth in numbers. It's a structural shift in how the economy is financed. Capital raising in our market has also seen strong momentum. In FY25, equity and debt issuances together amounted to 14.3 trillion rupees. In FY26 so far, from April to January, an additional 11.6 trillion rupees has already been mobilized, which included capital raising through 329 IPOs. In 2025, India led in IPO activity globally with record number of IPOs and stood third in terms of IPO proceeds. Mutual funds have become a major channel for household participation. Assets under management had grown from around 9% of GDP in 2015 to about 23% today. SIP assets now represent nearly 20% of total mutual fund assets. The ownership structure of listed companies is changing. Individuals and mutual funds together now own around 21% of listed entities, compared to 13% in FY15. This means the Indian household is no longer a peripheral participant. It's now central to the equity story of India. But growth also brings new risks. More participants mean more responsibility. More innovation means more complexity. This is where regulation must evolve. Regulation itself has changed with the market. We are moving from a framework that focused largely on entities to one that focuses on their activities and risks. We are moving from silo oversight to a more coordinated regulatory architecture. We are also moving from static rules to dynamic supervision. The role of regulator is not limited to regulations. It's about being a market developer, a guardian of integrity, and a protector of investors. Regulatory consistency and proportionality matter. They are not constraints on growth. They are enablers of confidence. As markets scale, the quality of regulation becomes as important as the quantity of capital they attract. Let me now turn to some of the key reforms that are shaping this next phase of market development. These reforms are not about fixing yesterday's problems alone. They are about preparing for tomorrow's markets. To support India's expanding economic aspirations, we are building deeper and more diverse markets. Indian securities market is the first major market to implement T+1 settlement cycle. This reduction in settlement cycle has resulted in reduced risk, faster access to capital, and improved operational efficiency in the market. Our market microstructure allows for granular client-level visibility as compared to omnibus structure in many advanced markets. Our depositories are handling over 210 million demat accounts, while exchanges process around 40 million trades in a day in cash market segments. To facilitate capital raising, we have simplified listing frameworks, reduced listing timelines, and proposed easing of minimum public offer thresholds for large issuers. SEBI has taken several steps to strengthen the corporate bond market. Introduction of electronic bond book provider platform led to increased efficiency and better price discovery in primary market. The requests for quote and online bond platform providers are helping improved price discovery in secondary market. Further, RBI and SEBI are looking forward to introducing a framework for derivatives on corporate bond indices, which will further deepen the corporate bond market. To bridge the gap between mutual funds and portfolio management services, we have introduced the Specialized Investment Fund. For foreign investors, the Swagat FI framework now offers easier access through unified registration, simplified documentation, and streamlined compliance. We are working towards paperless and digital signed workflows to improve FPI onboarding experience. Reforms in the block deal framework and the introduction of the common contract note for institutional trades will bring greater clarity and consistency to large transactions. The decision to introduce closing auction session in the equity cash segment is another major step. It ensures that the closing price reflects collective market consensus. It also enables passive funds to transact at the closing price, helping reduce the tracking error. A market deepens only when supply and demand grow together. We have revised the distributor incentive structures to encourage onboarding of first-time investors from beyond top 30 cities and to enlarge participation of women investors in mutual funds. To improve retail access, the minimum investment threshold in privately placed bonds has been reduced. Moreover, issuers can now offer incentives in public issues of debt securities. To promote ease of doing business, we have streamlined IPO processes and created a single filing system to reduce duplication. Related party transaction disclosures have also been simplified. Flexibility has been introduced in BRSR core, allowing listed companies to opt for assessment or assurance. Comprehensive reviews of key regulations covering mutual funds and stockbrokers have been undertaken to make them more coherent and contemporary, while the review of LODR and settlement regulations is ongoing. We have implemented several reforms aiming at ease of business to promote alternative investment fund segment. We are also looking at the ease of exit too in addressing some practical difficulties. Investor protection is not a separate pillar. It's embedded in everything we do. We have introduced validated UPI handles and the SEBI check tool to help investors verify intermediary bank accounts to prevent cyber frauds. The Unified Investor app provides a single view of holdings across depositories and simplifies e-voting. The Mitra platform helps track inactive mutual fund folios and improve KYC accuracy. We have also launched a unique initiative called Parva to ensure that performance claims by intermediaries in future can be presented to investors in a verified and standardized manner by a third party. To further facilitate the investors to get rightful access to their securities, recently we have opened a special window for transfer and dematerialization of physical securities. We propose to considerably ease the process of transmission of shares as inheritance. To protect the interest of investors who pledge their securities, we have proposed to strengthen the pledge framework through depositories. To further ease investor onboarding, we have also proposed to streamline KYC processes further.
तो आप सुन रहे थे